Jake, why don't you tell us a little bit about your powerlifting? Says here you can powerlift close to 650 pound or 625 pounds in your deadlift. Tell us a little bit about this. How did this come about?
Yeah, we'll hopefully get to 650 soon. So I actually used to be a runner. I wasn't a particularly good runner, but did a lot of distance work, a couple marathons. Um, didn't realize I didn't like it till I stopped doing it, but was forced to stop. Uh, I lived in India for a year, and broke my, and I didn't know at the time, broke my ankle when I was there. I fell off a train in the rain, and they don't have great standards as it comes to railings and things to hold on to, and proceeded to walk on it for the next 8, 9 months when I lived there. Ran at it a bunch. By the time I got back to the U.S. and went to the doctor, they're like, there is no tissue left between your leg bones and your ankle. It's all dead. How are you walking? I was like, painfully. They did a pretty cool surgery where they took some stem cells from inside my femur, spun those down, created a little platelet, regrew something like ankle cartilage. But we're basically like, you're not going to run again. Like, don't do high impact stuff like that. But yeah, exercise has always been an important outlet, always been an important way just to, almost meditate, decompress, among everything. And yeah, found weightlifting through a friend, and it just turned out that's actually what I was built for. Not running, which had always been sort of a square peg round hole. It's fun. There's a lot of science to it, and I can geek out on, how do I maximally, step up? How do I avoid injury? It's all about thinking about the physics and leverage points of different joints. And then, deadlift in particular, just based on how my body's built, relatively long legs, short torso. I have strong leverage when it comes to sort of the snap up movement in deadlift. So yeah, work on everything, but that's one where I can always sort of punch above my weight class, so to speak. And yeah, keeps you honest. Your body will tell you if you put that much weight on your back, and you'll know pretty quickly if your form's dead.
Oh yeah, makes sense. Yeah, there's some cool science to that. To your point, that's pretty amazing. That's awesome.
Yeah, how's your foot these days? Do you have any issues like walking anymore, or all good on that front?
I'm sort of like an old man in that I can feel a storm coming. Like the low pressure stuff, I definitely feel. If I go on a long run on, every once in a while I have to run. I had some work meetings that are runs. I'll feel it. It doesn't feel great, but it's not the end of the world. And then it helped me complete my transition from snowboarding to skiing, which made my dad very happy. He's a big skier. I grew up doing both, but gravitated towards snowboarding because I was a teenager and it was cool. That does not work anymore, but ski boots are basically big casts, and so my ankle feels fine in those. And I'm back to the good side, as my dad would put it.
Love it. I just switched over from snowboard to skiing a couple years back too, and easier to pick up. I like it a lot.
Yeah, I think you can get proficient in skiing much faster, and you can spend the rest of your life becoming an expert. Snowboarding, the learning curve, just given where your center of gravity is definitely a little harder to pick up, but you can get, pretty passable pretty quickly. So it's fun how those have sort of different learning curves to them.
Absolutely. Awesome. Well, Jake, why don't you dive into your background a little bit? Tell us about your start in the finance industry, and take us back to the beginning of your career and kind of lead us up to where you're at today.
Yeah. So not to pull back the camera too much, but my interest in investing started when I was 7 to 8 years old. I was growing up in San Francisco during the dot-com boom and bust. And, in as much as an 8-year-old can be aware of these things, saw fortunes made and destroyed. Practically what I saw is our next door neighbor went from driving a beat up old Honda to a Ferrari, back to a beat up old Honda. And I was like, well, that seems interesting. Like, I should learn how to play that game better than he did, and maybe keep the Ferrari. Though now I'm more a fan of practical cars, but at the time a Ferrari was a pretty cool thing. So started just with a paper portfolio when I was young. It was all shot in the dark. Hey, I've heard of that stock. I buy that. I've seen people buy that thing stuff, but it gets you into markets and you start thinking, what is price? Why do things go up and down? It's not just that I like it. If everyone else likes it the same amount, it's not going to go up. It might even go down. Also found a passion for poker at a pretty young age. One of those people who you call uncle, but isn't actually related to you. Taught me how to play with nickels and dimes when I was 12 or so. And, that sort of struck a similar chord of like how interesting to like mix math and people in this way of, I do need to be able to calculate the odds, but I also need to look my opponent in the eyes and understand them and their motivations. A lot of similarities to markets. By the time I got to college, was managing, some money for friends and family, was mainly focused on like currencies, fixed income, commodities, more macro oriented stuff. Had read a bunch of the Steve Drobny books and Alchemy of Finance. And, they're this is a time where macro idols were the idols, at least for me. A lot of Edward Thorpe too. That was the mix of gambling and investing. And I was writing about that. Apparently some of the investment folks, including the CIOs at Bridgewater, had found that blog. Not sure why. I don't know what I'm talking about today, and certainly didn't then, but that led to me going there as an intern from while I was at Chicago. Went back full time, spent about 5 years there, all told, as an investor. Wore a few hats, worked, with our clients on big, portfolio construction, asset liability matching sort of projects, but spent most of my time on our rates and credit team, particularly focusing on risky credit. So emerging market debt, high yield fixed income, how to think about how risky borrowers in an economy work. When will they lend? How will that impact prices? From that vantage point, saw firsthand that most of this activity, or at least a lot of the marginal activity, was moving towards the private markets, and that we weren't able to capture that whole ecosystem or how credit conditions were flowing through just in the public markets we could trade. And, Bridgewater was 100 billion levered 10 times. They're not going to be moving in and out of private markets anytime soon. And I, struggled to get excited about not doing what I thought was like the most interesting trade in that market. And so, it was an awesome place to cut my teeth. Some of the smartest people I ever worked with, but had to lockpick the golden handcuffs there in late 2019, just seeing this opportunity and wanting to be where the action was. It was one of those things where, you hope for some hard work, but also some luck in your career. Had a friend, we'd overlapped at Bridgewater for a while. He at that time was Joe Lonsdale, founder of Palantir, Addepar, 8VC, a bunch of other stuff, his chief of staff. And it was right around the time I was leaving Bridgewater. He called me and said, I really think you should meet my boss. I think I was actually driving back from the East Coast. Maybe I was in Iowa at that point, and said, yeah, sure, set it up. I got a call back. All right, you're going on a run with him on Monday. So back to the running thing. I was like, oh crap, I have not run in years. So Saturday and Sunday, when I got back, practiced, talking while running, and had my ankle, swelling up, and wanted to make sure I could make it through, 2-3 mile run without vomiting on a very important person. But the run, luckily went great. And that turned into, some hydration, some lunch, time at the whiteboard together. And it was very clear that first day that we were going to build something together. He'd been thinking about the same, private market space as chairman of Addepar, seeing just how hard it was for fiduciaries across the country and the world to build, robust, scalable, and, unique and differentiated private markets programs for their clients. How big of a need that was and how bad the existing technology, data, and resources were. And so, within a few days, we were, talking about founding Opto, pulled in Matt Reed as well, who's a principal engineer at Addepar, had been there for most of their growth, and was a previous, literal rocket scientist. When people say it's not rocket science, that's fine for most of us. For him, it'd be fine if it was. And so I had an early collaborator on the on the technology side, and three of us just pushed this idea and officially spun it out of the APC Build program in October of 2020, and have been growing and learning for the last 3.5 years.
Yeah,
That's
very
amazing.
cool. A couple different directions I want to take this, but I want to start with how they found you at Bridgewater. So you were saying that you were just kind of like blogging online, or were you like posting on Reddit, or what did this look like? And they just found you like that from Bridgewater?
Yeah, and I tried to get more detail on this once I got there, and it was like weirdly opaque for a place that's transparent by nature. But I was I had a personal blog, and then this was a period where like seeking alpha was a lot more trafficked than I think it is today. Like a lot of people were writing pretty substantially there, so I was using that as well. And then co-founded a group, the Chicago Students Proprietary Trading Club, with some friends, and we're actually putting those ideas on there, which is fun.
Yeah.
So yeah, all those things came together. I think it also helped, as a double major with the econ and classics, and Bridgewater cares about the long view.
Mm-hmm.
And some of my posts were about how borrowing and lending systems worked in ancient Rome, and I think that maybe caught some interest as well.
That's really cool.
Yeah, that is cool.
So it's really cool too. Like just like a large company like that, could just like find somebody online and reach out to you and start your career like that.
Cool spots. It's a big company and a small company. There's 1,500 people overall. When I was there, at least there were only about 110 of us in the investment engine. And so that group's actually really tight knit, and you get to know everyone.
Yeah, and then you mentioned you saw a need for private market access, for individuals to be able to invest. So talk to us about kind of the opportunity you saw there, and then kind of walk us into what you guys are doing at Opto.
Yeah, so this story, it starts decades ago with the first folks at Blackstone and a couple others, realizing that there were creative things to be done and how small businesses were structured. But the story really accelerated in 2008, which is a little counterintuitive because the world was falling apart. But what it did was, in the aftermath, as the Federal Reserve and other global central banks printed money, created a lot of real capital with very long horizons. And so saw the growth of sovereign wealth funds in this period, who no longer wanted to hold bonds that were yielding extremely low rates. Pensions and endowments had to move out of traditional assets as that flux of capital from central banks pushed down expected returns in public markets. And so created a large community, larger than just like, the Yale endowment model starting in the 90s, who were trying to adopt a view that matched their horizon. If you're a sovereign wealth fund, you have a 100-year period to think about payback. Like, why not match your investment thinking to that? Who cares if things up or down next week? And, all else being equal, if you can access capital at similar costs, why not stay private as an entrepreneur, or as someone who's borrowing, or as a real estate company? The additional regulatory burden, the staff you'll need, and just the cost of operating in those models is much higher. And so you had this dynamic where much more activity shifted towards this side because the capital was there to support it at reasonable enough rates of return. And from the side of the business that's borrowing, or the business that is issuing equity, or the real estate project getting off the ground, if you can do it that way, why not? Like, now I don't need to go hire a 15-person regulatory and legal team and an IR team and host quarterly calls and do 10 Qs and all that. Obviously that comes with, you need to be working with savvier investors who can, work without that sort of perfect information. But it also creates a lot of opportunity if you know where to find it. Now, why is that? It's a couple things. One is, and I think this still applies today, if you think about the basic equation that every investor deals with, I have my total return, and that's going to be equal to what I can get from cash, either the Fed short rate or just putting it in a bank or a CD, plus beta, which I think about a bit more broadly than just like the coefficient to equities. Just, I think about it as just, what does the market give me? And that can be in bonds, equities. How much return per unit risk can the market provide? and then alpha return over that beta number. Now, a lot of wealth advisors, to put it too bluntly, had a really easy job in the 1990s. Most folks were thinking about or requiring return in the 7 to 9% range. Bonds were yielding 4 to 6%. And so beta just had to return an additional, 4 or 5%, depending, could even be less some years. And I'd be at my required rate of return and I'd look like a genius. Now, in the basically 10 years following 2008, cash rates were zero. It just so happened that because of that and because of the money from the Fed, the beta returns were the best basically ever. So, fun fact, the 60-40 portfolio, if you take excess returns, the return over the cash rate, 2010 to 2020 was the best 10-year period since 1830, which is about as far back as we have reliable data on these things. The best 10-year period. And so a lot of people still were like, well, I can meet my required return just by doing the normal thing. COVID, inflation, rate rises, things looking a lot more like the 1970s than like the 90s through 2020 have woken the wealth community up. And you basically don't have diversification between stocks and bonds anymore. You really can't rely on beta being particularly high on a go-forward basis because of all that capital that's flowed in the last 10 years. And cash rates are higher, but if we believe market pricing, they're only set to be roughly 3.3% over the next 10 years average. So, that's not going to return your portfolio in the way you need. So part one of why the private market access is important is better beta. When you look at the valuations of public companies, when you look at what they've done for investors outside of, a very small handful, Magnificent 7 going down to, maybe Magnificent 1, 2, or 3. It hasn't been the diversified high quality experience that it had been historically. And that's backed up by things like, there's half of the number of public companies that there were about a decade ago. More and more activities happening on the private side. And what's more, the important activity is. And so whereas, like Amazon IPO'd, and I'm going to get this probably off by a year or two, but let's say IPO'd roughly 4 or 5 years into their existence because they needed capital to fund expansion. And normal investors could participate in that expansion. Now, when you think about when are companies IPOing, they're already worth $30-40 billion. They're not IPOing because they need capital to expand. They're IPOing because they want liquidity for early investors. That's a much less risk premium rich transaction than when you're investing in a business that needs capital to grow. And so to get better beta, to make that equation balance, you need to be thinking about adding private markets. And also, if you just want, if you believe roughly in CAPM and holding a balanced portfolio, you're ignoring a huge and growing part of the market by not including that. You're tilted towards one side in a way that probably isn't compensated. But that alone is not the most important reason. The most important reason is the ability to generate alpha and to provide real outsized return regardless of market environment, potentially. Why do I say potentially? So I have a very simple framework. I think there's only 4 ways to outperform in markets. You can have unique information, unique access, unique insight, or you can get lucky. We can all hope for luck, but probably don't bank on it. Unless you have a really special rabbit's foot or whatever. The first 2 are illegal in public markets. That's insider trading. Do not collect $200, go straight to jail if the SEC is doing its job correctly. But that's the lifeblood of private markets. And that's not in some nefarious backroom deal sort of way. It's as simple as, if I'm founding the next great defense startup and it's going to protect, our troops and allies across the country with drone detection or anti-drone capabilities, or the battlefield is changing a lot. But regardless of what they're doing, what is that founder going to do? And maybe it's like the perfect person to found it. They're an ex-SEAL. Their co-founder is hyper technical. They know someone who in the procurement team. Like, this is the right team in the right place at the right time. What do they want in their backer? They're going to want a vote of confidence from the VC that backed the last great defense startup. That's going to be their first call. And that VC is going to have better data on the defense ecosystem and also know vendors and procurement policies and have advisors and contacts. It's going to accelerate the growth of that firm. And so it's not some, backroom thing. It's as simple as, like, in many ways, success builds on itself in this space and allows those who have outperformed to potentially compound and increase on that. And we see this in the data where, for venture and private equity, if you're a top quartile fund, the odds of persistence, i.e. the next fund in your fund series is also top quartile, very high, north of 75%, with the very important caveat of you can't grow too fast. If you're growing your funds at more than 150, 200% fund over fund, that number gets pretty dang close to zero. It's more like a coin toss.
Like an issue with sizing these investments is what you're saying.
Yeah, and you have this unique access and information that led to outperformance. How much can you scale that? Defense is, as an example, is a relatively limited industry. There's only so many Pentagon projects that can be allocated. If that's your edge, maybe you could very productively deploy $300 million. Deploying $3 billion is, you're going to dilute yourself.
Right.
And so, we again see this in the data where, the difference between a top quartile and bottom quartile public hedge fund is 4 or 5%, like for equity long short in a given year. It's more like 30% for venture capital. And so if you believe that you can get access to the right networks in private markets, that alpha component can be very significant. And if it's real alpha, it should be relatively agnostic of what's going on in markets in general, with growth, with equities, which provides a bulwark for your portfolio in times of stress, in times of inflation, in times of rising rates. And so, as it pertains to Opto, we focus on a total portfolio view. So it's really, what can private markets do in your portfolio? And we've developed, leading portfolio construction tools to marry the liquid and illiquid together. And then how can we partner together and be aligned to focus on opportunities for alpha? Obviously you can never guarantee it. Past performance is not indicative of future results, but with the right diligence and right alignment, you can increase your odds of landing in that top quartile more often than not.
That's interesting. I appreciate the background as well, kind of bringing us up to the current day. I'm just curious what your thoughts are on the current markets today and the private markets. Where there's some current problems, maybe with technology, it's always been a challenge. Where do you see see that from this lens currently?
Yeah, so there's a lot of challenges, which means we have a lot of opportunities here. I'll start with technology, which this space is really a few decades behind a lot of other modern B2B areas. And take an example as simple as the wire transfer, which is how you fund most positions. Wire started as a way to pay people over the telegram. How are we still in 2024 using wires as the primary way you fund private markets allocations? We have better ways of doing this. The space just hasn't caught up. Very common to see fax machines still in use and hard copies being scanned, and just a lot of legacy processes that have been allowed to stick around because most private funds have primarily worked with big institutions over the last decade. And so maybe you have 300 clients. At 300 clients, if some processes really are slow and inefficient, it's not the end of the world. If you're going to work with 30,000, 300,000 families, you're going to notice pretty quickly that you don't have the technology to scale. But it's not just about the operational side, it's transparency. How do I know what's out there? Like, there is no Bloomberg for private markets. How do I compare this managers to others? How do I get in contact with them if I'm interested? Understand if I'm a fit as an LP. Do things like evaluate the docs. Like, they're going to send me a probably 65-page private placements memorandum in legalese. Like, how do I, as an investor, understand, is this at market, below, above? Where should I try and negotiate? None of this exists. There's no infrastructure in place. And so we saw a massive opportunity to build workflow software. We go horizontal and vertical here, where it should really cover end to end, from the question of what should I do in private through to transaction execution, transferring money and ongoing management, and going deep in a few places on the way in terms of portfolio construction and analytics, diligence management. Like there really is no CRM for diligence. Like how do I keep track of all the funds I know and what I know about them? Like doesn't exist.
Right. Yeah.
And then, client interaction, proposal generation, automating subdoc processes. There are bits and pieces out there, and there's some firms that, we have a lot of respect for as well, but we didn't see anyone bring it together in one place as well as we wanted. And so, a lot of the benefit, we'll even partner with these things. We have no, if someone else has built something we need better than us, like we have no ego about just integrating with them. But advisors are busy people. And if I'm asking them to like copy paste from PDF into Excel, upload a document back to export, like it's just not going to happen. It needs to just work. That's one of our core building principles. Like it just works. So that was a lot of the gaps on the technology side. That relates to, I think, one of the biggest gaps here, which is alignment. So, again, rewinding to the financial crisis, there really was no access to private markets for the wealth community. That started to change largely in the form of sort of placement agent like shops. And so like a GP, a fund who's trying to grow really quickly, paying 1, 2, 3, 4, 5% to a distribution system to raise capital for them. Which makes a lot of sense as a business model. If that doesn't exist yet, that is the quote fastest way to revenue as a business, like that you get paid today. Has an alignment problem though, which is 1, the best funds don't need to pay to raise capital. And 2, my incentives are just to raise as much capital as quickly as possible, not to find the best parts of private markets. And so, another thing we've done, and look, we think there's room for multiple models here in terms of accessing, private market beta. Maybe you don't need like as aligned of a partner, but with us, we put our own capital to work alongside our clients. We serve as a fiduciary to the custom funds that we build with clients. And we, flat out refuse to accept any money from GPs, which, helps with making sure that only, those funds that will really contribute to our client portfolios end up in pipeline.
Makes sense. Talk to us about some of the funds you guys work with. Obviously we've, talked here a lot about private markets, private companies. Are you guys working with like VC funds? You guys setting up SMAs or, what other type of funds beyond private investments are you guys making, allocating?
Yeah, so we really focus in on the private side of things. There's a whole world of alternatives out there. Hedge funds, crypto, art, the list goes on, where we've tried to keep a relatively narrow focus on private claims on, debt or equity like structures. And so that's venture capital, private equity, private real estate, both commercial and residential, private credit, and infrastructure. And, that helps you, run the gamut from the growthier side, obviously venture capital being a, longer term hold, more upside. And we work some really cool venture firms. We focus a lot on early stage, Series C, Series A, and on, VCs who are backing really big ideas that, the world will be a better place if we can bring them to life. And it tends to be when you get in on one of those things that it ends up being a good investment as well. In private equity, there's a few different slices of that. There's, traditional, it's called leverage buyout. So, use leverage to buy. The typical transaction we hear about is like the Midwestern cement company and buy 5 of them and put them together and try and drive some efficiency. There's growth equity, there's sort of turnaround restructuring, companies under stress. We more look at like, how does the management team operate? We really focus on private equity managers who take a really active role in their portfolio companies. And that can be through an LBO, that can be as a growth equity company, but a big emphasis on operators, people who've run businesses themselves before, know what can actually make things better and it's not just a cost cutting effort, but also a growth in the top line to drive value as well. And when you look at the data, that's much more persistent. Those private equity firms that achieved returns through not just multiple expansion or margin increase, but through top line as well, have a very consistent performance through time. And then, infrastructure is a big asset class too. That could be buying a port in some random country, a toll road, or really cool stuff around like revitalizing the American grid and making electricity delivery faster. Real estate is one that most people understand off the bat. Most of us live in some real estate and work in some real estate. And it's kind of a lot of that. And then private credit, because of the Bridgewater background, is a particular passion area for me, where you can get really creative with how you provide financing to companies. Especially when you think about like who's going to go tap private credit markets. It's often when companies or ideas that would struggle to get bank financing, that can be for good reasons and they really shouldn't get funding, or it can just be for regulatory reasons, especially after the regional bank pullback last year. There's a lot of great ideas that just can't access traditional pools of credit financing that are turning to private credit markets. That said, I think if there's a space within privates that I'm worried about, it's a slice of the private credit world. But we can go there if we want, but those are the areas we traffic in.
Well, that's great. That's great. I'm just curious. People talk a lot about alts and what the role alts plays in a portfolio. What do you think about that today in the current state of the economy, from your perspective?
Yeah, I think that investors should be positioning for a period of heightened uncertainty. And it reminds me, this is not a novel point here. Others have made this, but it feels relatively similar to, say, the economy in 1971 through 3 or late 70s. There's even corollaries back in like the 2010s and 1910s and 1920s. But what that means is, I kind of think about it as putting on a ridge. And I'm not a golfer, but I think I understand enough to make the metaphor, where the hole can be right ahead of us. And like right now, things actually look pretty good. Equities are doing well. Most earnings reports are positive. Bond yields have come down a little bit and they're priced to go further. That's pretty Goldilocks. It might happen. The ball might roll straight to the hole. But we have big hills on either side, and those hills being, inflation, and then, recession, like deflationary deleveraging. On the inflation side, we have an election year, depending on how policy shifts and or promises that are made during that. You could sort of pour some jet fuel on what's still an overhot inflationary economy. We have increased geopolitical tensions, potential increase in tariffs and reduction in trade. All those things could be inflationary, while not really spurring any growth. And so you'd end up in a sort of stagflationary mess, and both equities and bonds do very terribly in that environment. On the flip side, the Fed either raises again, doesn't cut when expected, some negative growth shocks come in, and we're in a place where, we're back in, maybe it's not 2008, leverage levels are not as high. I'm less worried about a spiral, but a period of stagnant growth and deflation. Bonds do fine in that world. Equities do not. Most people are overweight equities. And so where do I see, alts, not just private markets, but alts in general coming in, is diversification and having multiple win conditions. I like multiple win conditions. I'm a poker player, try and look for multiple outs. And, with the globalization of capital markets and, information speeding up in markets, everything is correlated now. Like it used to be, if I held like the Dutch stock market and New York Stock Exchange, like they'd be pretty different. Now it's very rare to see a day where one rises and the other falls. And that's that story repeated, across space and time, and even in places that are as disconnected from our system as like Chinese equities. Those mainly go down. And so alts, which have different pools of capital holding them, different buying and selling dynamics, and in many cases sort of unknown long-term correlation to Traditional assets, it's a bet, but that's why you want to spread your bets. Take a few potential sources of diversification, something that may serve as a safe harbor, and or does not experience the price action. And that can have a ton of benefit. I mean, so much of finance is just being there tomorrow, having some persistence. And if equities go down 40%, you want to be the person with something to pull on so that you can buy. Most people are not in a position to buy more at those levels. That's what having actual diversification allows you to do. Rebalance into those periods that tend to lead to outperformance.
How do you guys go about selecting managers for your platform? And, maybe talk to us a little bit about the due diligence side of things.
Yeah. So there's sort of three angles here. So one is a top-down view. We maintain macro research, looking at areas that based on pricing and economic conditions are likely to be good places to allocate in the coming years. And so we're going to have sub-asset classes that we're more focused on. A lot of it is network-led. And so from, Joe Lonsdale's network, the network of our investors, we have top family offices invested in Opto, the GIC, the Sovereign Wealth Fund of Singapore, is an investor, going out to them and saying, what are the best things you're doing? Super helpful. And then from our clients, and that's both what they're looking for. Like, hey, I'd love to see something in healthcare or private equity. But also they have a lot of good ideas. Sometimes, private equity principals are their clients, and they might have a slice of the private markets that they actually have excellent access to, where we're helping is to round that out. But we can take that access and spread it across the Opto network. And so, no one has a monopoly on good ideas. We're looking, high and low for interesting people who are really innovating in how finance can support the private markets and provide great returns to their clients. In terms of the diligence process, you get a lot of leads, both from those three I mentioned, then we get a ton of inbounds. It's impossible to look at everything in depth. And so we built some pretty neat artificial intelligence tools to help with the screening process. And so we can upload PPMs and LPAs and decks and 4-pagers and immediately benchmark funds versus their competition, put them into our database, understand how they relate to their peers. And, depending on the asset class, have tools for sort of getting to do we want to double click or not? Like, as an example, in early stage venture, one of the most important things, most predictive of future performance, is who are your co-investors and follow-on investors? Does Sequoia lead the Series B in the companies that you do the seed and sort of thing? And we can pull that automatically. We have access to all the deals they've done and can build these like affinity matrices where it returns a score of how good is their co-investment network. And if someone's above, call it 80th percentile, we should probably learn more. And so we can go from, say, 1,000 intros a quarter down to 100 that we're going to double click on. That's super helpful. From there, it's still a pretty human-led process. We have 3 S's: strategy, structure, and sponsor. So on the strategy front, that's a lot of what we discussed earlier. What is the unique access? What is the unique information, the unique insight? What's the approach? Why has it hopefully led historically to outperformance? And why is it set to continue? And that's, reaching out to portfolio companies. That's talking to other LPs. That's, doing a lot of research on how they've driven growth historically. And then structure and sponsor is a lot of stuff that historically gets grouped in operational due diligence, but we really think of as just as important. And that's stuff as basic as, calling auditors and making sure they exist. If anyone had bothered to do that for Bernie Madoff, that scam would have ended a lot earlier. His auditor was an empty room in New Jersey. But also looking at, how are the GPs aligned? Is the CIO and CEO of this firm putting personal capital into this fund? Are they incentivized for it to outperform? Are they double dipping? Sometimes people will both charge a deal fee that goes to the parent and make money on the fund. That's not very aligned. They'll just do more deals to make money that way. How are they using leverage? Do they have staying power? We have one, it's just sort of a yes/no metric that we call the Ibiza score of has the person who founded the company gotten so rich that they mainly spend their time on a boat off of Ibiza and are no longer an active investor. and maybe some of that unique access and information was really person dependent, and now they're off partying.
Key man risk. Yeah.
Yeah, and so it depends a lot on the sub asset class, what specifically is the most important. But a sound strategy with clear unfair advantages that look like we'd outperform, and then a structure and sponsoring organization that are robust and are going to be here for the long haul.
Any size, I guess in terms of like fund sizes that you guys work with, what's kind of the maybe low end or high end, or do you guys kind of have a range that makes sense for your partners?
Yeah, we're pretty agnostic, and if anything, favor things at the smaller end. But it depends a lot on strategy. And so, as an example, like seed stage venture, we like small funds. A few $100 million or smaller. Seed checks shouldn't be that big. Writing 1,000 seed checks seems hard to do well, and so like we wouldn't want to see $1 billion seed fund. Whereas in parts of like mezzanine private credit, the only way you're going to win deals is if you can like create a large enough revolver facility, and so size can be helpful there. There's limits to that. Like I like 2 billion. I'm not sure I like 20 billion. But size, there's places where size can help strategy, and there's places where it can distract. And so it's definitely dependent. And then again, what we look at a lot is how fast are they growing, and are they growing too fast? And so more even than like absolute size of the fund in many cases, you just deployed $100 million, you're jumping to $1 billion, and you haven't grown your team. Like, how's that going to work? So yeah, I mean, we worked with funds down to 40 million. We've worked with funds up to 10 plus billion. And we hope we've found places where size, either on the being small or being large, is additive to that strategy versus counterproductive.
Yeah, definitely. Yeah, I appreciate you saying, Jake. Obviously, it could be asset class specific based on size and capital constraints of that specific portfolio, right?
Yep.
How you determine that. I'm just curious from a qualitative and quantitative point of view, what you see this year, given the due diligence that you've done on many different companies. Any unique trends that you're seeing coming out for this year specifically, or going forward?
Yeah, so I alluded to it earlier, but we're a little worried about all the capital that's flowing into these like evergreen private credit structures, the big BDCs and the like. And the reason for that is not that those firms by and large actually have great long-term track records, but we're sort of entering uncharted territory with how much capital is flowing in there. If my firm got $4 billion in new commitments over the last quarter, and because I'm evergreen and I strike NAV quarterly, I basically need to deploy it over the next quarter. It's not like a drawdown fund where it could take years. I need to go write some pretty big loans because I need to do $4 billion of loans in 3 months, and there aren't that many companies in the world that can take a $300 million or above loan. And if I did that, and both of you guys run similar shops and you both did that, well, we're probably all reaching out to the same small handful of companies who can take our very large loan size that allows us to deploy enough over the next quarter to keep the fund in place. And so you've seen a significant degradation in the quality of covenants, in the level of yield, in any form of like collateral coverage, in the sort of, definitely 500 million and above loan size, but even down to 250 and above, which based on overall macro is counterintuitive. I mean, you had a period where banks have both literally failed and pulled back from a lot of activities. The Fed has raised rates. All else equal, you'd say, well, capital should be more expensive right now, and it should be a lender's market, not a borrower's market. But because of that forced lender dynamic on that like hyper largely mezzanine direct lending space, you've seen a degradation in conditions there. So our focus is definitely tilted towards smaller, nichier opportunities, and waiting that out. Now, I should say, I don't think this is like a powder keg ready to burst. It just feels like not an awesome deal. Like if I get 8% yield all in, And I look at, the underlying companies, and I look at their sales leverage, and I look at, how likely they are to default. It looks like, call it 16% volatility asset. Well, like, and cash rates are, 4 or 5. That feels a lot like equity, like return at equity, like risk, but I don't have equity like upside. So, not necessarily saying anything's going to blow up here. It just doesn't feel like a good deal. I'm going to take that kind of risk when I
Yeah.
get something here.
I think that brings up a really interesting point because uh, I'm not like super deep on the fixed income side of things, but like from what I've seen, like the high yield spreads are not or they don't seem very significant compared to like what you're getting for like treasuries. Do you think that kind of and maybe I'm totally wrong on that, but does that kind of,
No,
play a role into that, you think?
they're less elevated than you'd think. And it's related to this dynamic because it's the same large companies that could basically choose to issue high yield notes or choose to do these private credit transactions. And so this influx of private capital into private credit transactions at the high end has reduced high yield issuance. And, it's just buyers versus sellers. If you have less people selling high yield debt and the same amount of people buying, the yields will stay low, compressed. So yeah, part of that same dynamic. And so we're not focused there. On the positive side, I think there's a pretty interesting way to play the artificial intelligence wave right now. And I think in 2 years we're not going to be talking about AI as an industry in the same way as we don't talk about .com as an industry. So this is not me being an AI hype boy. Every company is going to be that. Most of the infrastructure is still missing. I mean, it's things as basic as, you know, cloud data centers weren't built with a lot of GPU racks. Like someone's going to have to go do that infrastructure project. The power requirements are much higher and more intense if it was going to build the grid that supports that. And so, but also developer tools, integration layers, all the stuff that we did for the cloud wave almost needs to be redone for the AI wave. And there's some pretty interesting ways to play that in a kind of picks and shovels sort of approach, which, and that's not to say that a ton of growth is not going to accrue to the winners in the space, the OpenAIs and NVIDIAs of the world. But there's again, I like multiple win conditions. Like we need a revitalized power grid either way. If a infrastructure manager can both benefit from the amount of capital flowing into AI, but also know that like, even if that goes away, the US probably needs to support the grid revitalization anyway. That's a pretty interesting transaction to be part of. So we like multiple avenues for playing AI, early stage venture, infrastructure, real estate, like all touch it. And then, private equity, there's sort of two themes there that I really like. One is, financials and technology have come under a lot of stress, and doing the public to private transaction thing of, taking a company that's now down 70%, fully private, and revitalizing it makes sense again for the first time in 7 to 10 years. And again, those firms with operational experience will excel at that. And then also, on the AI wave, ways of bringing operational efficiency to legacy industries. As an example here, medical billing, which is really just the insurance company and the hospital calling each other back and forth for 5 weeks to decide how much something costs, is like a multi-$100 billion a year industry in our country that doesn't benefit anyone. It's basically just dead weight loss for the economy. It is perfect for automation. Like this is a fully automatable process that both people on both sides are basically following scripts already. And so, if someone were to buy a hospital system or an insurer and reduce their spend on hospital billing by 70%, if they did a turn of leverage on that in a traditional private equity transaction, like that could be a 20 to 30% winner for them. And those tools exist in a way they didn't 5 years ago. I'm always looking for like what's possible today that wasn't possible 5 years ago, and that's a big one on the value add private equity side.
Yeah, that's definitely insightful there, Jake, to bring it up. And I appreciate you bringing up earlier your point about just certain infrastructure is not there yet. Even you think of cloud adoption in our industry really hasn't happened yet to the level we thought it would. infrastructure, unstructured data architecture, all these things that are not there yet to really take advantage to the full level. And AI has been around for 60 years. We're talking about generative AI tools and systems, right? So I definitely agree to your point. There's a lot of way to go to get to where we could really utilize it to the best of its ability. But yeah, I appreciate the different bits and pieces, though, uncovering inefficiencies to automate certain things that are ripe for disruption. Those are really
Yeah. Because to get to that world, it's going to be a handful of hardworking people working on what seem like some very boring problems to stuff.
Yeah.
Everyone wants to launch rockets and cure cancer. Those are super important things. I hope our best and brightest keep doing them. But someone needs to figure out how we reduce, insurance costs and hospital billing, how we, get rid of wire costs, how we make financial markets more transparent. I mean, I find those things fascinating. Maybe others do as well, but there's hard work, roll up your sleeves type work to be done here to make these new tools work efficiently as well.
Yeah, totally.
Absolutely. Awesome. Well, Jake, I have more questions for you, but we're running up on time here, so gonna let you go. We'll definitely have to bring you back on the show again, in the future. So thank you so much for joining us. Where could people go to connect with you and learn more about Opto?
Yeah, so we're optoinvest.com, optoinvest.com, or find us on LinkedIn, or I think we have a Twitter even. Yeah, we got a whole team ready to chat if you're interested in learning more.
Amazing. Well, yeah, we definitely appreciate the time, Jake, and we'll make sure to include that in the show notes.